This is the story of how a shift in Canadian regulatory pressure forced Empire Company Limited, the parent of Sobeys, to fundamentally alter its approach to grocery pricing. In late 2023 and throughout 2024, the Canadian government and the Competition Bureau increased their scrutiny of the nation's largest grocers, citing a lack of competitive intensity in the food sector. Sobeys, representing a significant portion of the domestic market with over 1,600 stores, responded by freezing prices on all packaged products during the critical winter months and expanding its discount footprint to mitigate political and regulatory risks. This adjustment marks a departure from decades of high-margin strategies, signaling a new era where corporate pricing is as much about political survival as it is about profit. For the average consumer, this pivot represents the first tangible crack in a long-standing retail oligopoly that has historically resisted downward price pressure. The consequences of this shift are now rippling through the entire Canadian supply chain, beginning with a strategic overhaul of how the company interacts with its suppliers and manages its retail real estate. The mechanics of this change are rooted in the 2023 amendments to the Competition Act, specifically Bill C-56, and the subsequent grocery rebate policies. Under this new framework, the federal government granted the Competition Bureau expanded powers to compel information from retailers and block anti-competitive collaborations. Sobeys' leadership recognized that their traditional model was becoming a legal liability under these expanded authorities, which now specifically target excessive and unfair pricing and the use of restrictive property controls. To adapt, the company accelerated the conversion of its full-service Sobeys locations into FreshCo discount banners, which operate on thinner margins but higher volume. This transition requires a massive reallocation of capital, moving away from luxury store experiences toward lean, logistics-heavy operations. By lowering the entry price point, Sobeys is attempting to preempt more aggressive government intervention or the forced entry of foreign competitors who have long cited high barriers to entry in Canada. This move is a calculated defensive maneuver designed to protect market share in an environment where the public has lost patience with rising food costs. The regulatory environment reached a peak in mid-2024 when the Competition Bureau obtained court orders to investigate the parent companies of Sobeys and Loblaw regarding their use of property controls. These controls, often taking the form of restrictive covenants and leases, have historically prevented competitors from opening stores in the same shopping centers or nearby lands. Sobeys, facing intense public and legal pressure, recently agreed to remove such property controls in specific regions, such as Crow's Nest Pass, Alberta, marking a symbolic victory for regulatory oversight. This legal shift is forcing the company to rethink its long-term real estate strategy, as it can no longer rely on territorial exclusivity to maintain its pricing power. The company's CEO, Michael Medline, has publicly stated that while the grocery sector is intensively competitive, the company must work harder with suppliers to reduce cost increases and mitigate the impact on retail prices. This admission reflects a transition from a margin expansion mindset to a cost containment mindset, where internal efficiencies must now replace price hikes as the primary driver of earnings growth. This Canadian regulatory crackdown does not exist in a vacuum, as it mirrors a global trend of greedflation investigations across the G7 nations. In the United Kingdom, the Competition and Markets Authority recently conducted a similar probe into supermarket loyalty schemes and pricing transparency, leading to immediate changes in how major retailers display unit costs. In France, the government mandated that retailers renegotiate prices with food producers more frequently to ensure that falling commodity costs are passed to the public. Sobeys is now benchmarking its internal compliance against these international standards to avoid the heavy administrative monetary penalties now possible under the revised Canadian Competition Act. The global marketplace is shifting toward a model where grocery margins are treated more like public utilities than traditional retail sectors. As Sobeys adjusts its long-term strategy, it is effectively adopting a compliance-first pricing model that prioritizes regulatory alignment over short-term shareholder dividends. These parallels suggest that the era of unfettered retail pricing power is ending across most developed economies. The real-world impact of Sobeys' strategic pivot will be felt most acutely in the erosion of brand loyalty as the market moves toward a purely price-driven landscape. As Sobeys continues to prioritize its Freshco discount brand and its own brand's portfolio, the traditional mid-tier grocery experience is slowly disappearing from the Canadian landscape. This shift forces a reorganization of the labor market, with fewer full-service roles and a higher reliance on automated checkout and low-overhead staffing models. Investors are also recalibrating their expectations, as the high-margin stability that made grocery stocks defensive havens is being traded for lower-margin, high-volume security. The company has committed to a multi-year plan to renovate up to 25% of its store network, focusing heavily on discount formats and digital integration through platforms like Voila. This indicates that the quiet reassessment of pricing at Sobeys is more than a temporary discount. It is a permanent structural change to how Canadians access their most basic necessities. This evolution suggests that the future of food retail will be defined by transparency and thin margins, or it will be defined by further government mandate. By early 2025, the results of this shift began to manifest in Sobeys' financial reporting, showing a stabilization of margins even as sales volume fluctuated. The company's focus has moved toward promotional optimization and the use of data-driven loyalty programs like Scene Plus to maintain customer traffic without the traditional reliance on high base prices. This strategy is a direct response to the value-seeking behavior of consumers who have been conditioned by years of high inflation to hunt for the lowest possible price point. Sobeys has had to navigate this while also dealing with the implementation of a national grocery code of conduct, a move intended to level the playing field between retailers and suppliers. While the code was initially met with resistance from some industry players, Sobeys was among the first to signal support, recognizing that a more transparent supply chain is the only way to satisfy federal regulators. This alignment with government objectives is a key part of their new long-term strategy, aimed at repairing a damaged brand reputation while ensuring the company remains viable in a more restrictive legal environment. Furthermore, the company is facing new challenges from external economic forces, such as potential tariffs and supply chain disruptions, which threaten to undo the progress made in stabilizing food prices. In response, Sobeys is pressuring its suppliers to absorb more of these costs, a tactic that would have been difficult to execute before the recent regulatory changes strengthened the hand of the Competition Bureau. The company is also seeing a shift in consumer preference toward domestic goods, which often offer more price stability than imported products. This has led to a strategic reevaluation of their sourcing maps, prioritizing local producers to reduce logistics costs and shield the company from currency fluctuations. Every lever possible is being pulled, according to company leadership, to ensure grocery prices remain competitive, a phrase that would have been unheard of during the high-growth years of the mid-2010s. The shift from a growth-at-all-costs model to a sustainability and value model is now the cornerstone of the Empire Company's 5-year outlook. Ultimately, the transformation of Sobeys' pricing strategy is a case study in how government intervention can reshape an entire industry. What began as a series of public hearings and parliamentary inquiries has evolved into a fundamental rewrite of the rules of Canadian retail. The company can no longer operate behind closed doors with the same degree of opacity that it once enjoyed. Every pricing decision is now subject to the potential for a Competition Bureau audit or a public backlash fueled by increased transparency requirements. As the company moves forward, its success will depend on its ability to execute this pivot to value without sacrificing the quality that its remaining full-service customers expect. The stakes are high, as failure to adapt could lead to more drastic measures, including the forced breakup of major retail conglomerates or the implementation of strict price controls. Sobeys is betting that by changing its strategy now, it can survive the transition to a more competitive and transparent Canadian market. In the long term, the Canadian grocery landscape will likely be defined by a smaller number of full-service, premium stores and a vast network of lean, efficient discount outlets. Sobeys is positioning itself to lead in both segments, but the internal balance of power has clearly shifted toward the latter. The Freshco banner is no longer just a secondary brand. It is the primary engine of the company's growth and its most effective tool for navigating the new regulatory reality. This shift represents a permanent cooling of the grocery market, where the high-stakes battles for market share are fought on the cents per gram level rather than through massive marketing campaigns. For the Canadian consumer, the end of the pricing move era means a return to a more predictable, if less luxurious, shopping experience. The quiet revolution in Sobeys' pricing strategy is the first major step toward a new social contract between Canadian retailers, their customers, and the state. As the dust settles on these regulatory changes, the industry will look back on 2024 as the year the grocery giants finally had to blink. The evolution of Sobeys also serves as a warning to other concentrated industries in Canada, from telecommunications to banking. The successful application of the amended Competition Act to the grocery sector has provided a template for how the government can tackle market dominance in other areas of the economy. Sobeys' proactive adjustments, though largely defensive, have set a precedent for corporate compliance that other companies may soon be forced to follow. As the company continues to renovate its stores and optimize its supply chain, it is doing so with a wary eye on Ottawa, knowing that the quiet shift in its pricing strategy is the only thing standing between it and more aggressive legislative action. The story of Sobeys is a reminder that in the modern economy, no company is too big to be influenced by the collective will of a frustrated public and a newly empowered regulator. The future of Canadian commerce is being written in the aisles of your local grocery store, one price tag at a time.